Okay, let's jump into chapter 13. But before we do so, I just want to make a couple comments. The first would be, of the entire textbook, whether it be for principles 1 or 2, I would have to say chapter 13 is the most involved. And being the most involved and challenging, we do spend a little bit more time, but it will require a two-way street. I would really suggest that you read the chapter not just once, but 2 or 3 times, really taking in the information, looking at all the examples, the journal entries, the exhibits, and really understanding before you move forward. Keeping in mind, the chapter talks about cash flows. There's 2 types. There's 2 methods, direct and indirect. We will only focus on indirect. Indirect. 99.9% of the companies in the world use indirect anyway, so rather than confuse and make a difficult chapter even more challenging, we will only look at the indirect method. So certainly take the time and look at the big comprehensive problem at the end of the chapter, looking at that, really taking the time to read it and understand it. You will also notice that the very first document that you print off as far as the chapter 13 exercises and solutions are concerned is this Word document called the Statement of Cash Flows. And this is what I would call my cheat sheet. It's a real good way for you to understand the cash flows all on one document. It details the 3 sections: operating, investing, and financing. The operating section is, of course, always the most challenging, and that's why we'll look at that in a lot more depth. Investing and financing are very straightforward. Let's talk about it. So if you have that in front of you, write these notes down. Investing is all transactions that revolve around purchasing and sale of long-term assets. Financing are all transactions that are with regards to long-term debt and the equity section, so common stock or dividends that we pay. The operating section, the first section, is the most comprehensive, but it's all transactions that basically come into the calculation of net income. So I said the investing is long-term assets. Financing is long-term debt and equity. So the operating is what's left. It's all the short-term assets and the short-term liabilities. Also in your notes, in the operating section, it's always in this order: net income plus depreciation plus amortization plus, if there happens to be a loss of any type, or minus of a gain of any type. And then the rest of the section is all the changes in our current assets and current liabilities. So again, net income plus depreciation and amortization plus a loss minus a gain, and then all the changes in our current assets and current liabilities. So make sure you have that document handy. That is certainly something that we will refer back to again and again. So let's just jump right in. If you haven't read the chapter 2 or 3 times and gone through the comprehensive problem at the end of the chapter and done all of that, pause this and do that first so you get the most out of these exercises. Number 1, it says United Continental, the parent company of United, reported a net loss of $723 million. And then it says, how can there be $935 million in cash flows? So notice here there's a big minus, but when it's all said and done, the operating section shows a positive cash flow of $935,000. So when we think about our expenses, all of our expenses usually involve the payment of cash. What is one expense that doesn't involve cash? It'd be right here. Depreciation. So notice there is a huge 1522 add back, and it's depreciation. So even though there's a net loss, ultimately we will still, in this case, have a positive cash flows, and it's mainly due to the add back of depreciation. All right, let's move to number 2. The effect of transactions on cash flows. So it says here, share the effect, cash receipt or cash payment in each of these transactions. So letter A, retired $500,000 of bonds. All right, so, and it says here, there was an unamortized discount for 510. So they retired $500,000 worth of bonds for 510. There was a $4,000 unamortized discount, which is irrelevant. We paid this bond off for 510, so it's a cash payment for 510. Sold, cash receipt, 20,000 shares times 30 bucks, $600,000. Sold equipment again, cash receipt for 72.4. Purchased, okay, cash payment for $825. Purchased, again, cash payment, in this case, only the 30 grand, because that's the only cash involved. F, sold, cash receipt, $400,000 bonds, but we sold them at 98%, so cash receipt $392. Purchased, again, so you take the 10,000 times 2250, cash payment of $225,000. Paid dividends, again, cash payment, $1.25 times a million shares is cash payment of $1,025,000. Number 3, identify what section, operating, investing, or financing. All right, net income, as we said in our cheat sheet, that's in the operating section. Letter B, paid dividends, equity, financing. Letter C, common stock, again, equity, financing. Letter D, bonds, long-term debt, financing. Letter E, bonds, financing. Investments, investing section. Treasury stock relates to common stock, financing. Equipment, long-term asset, investing. Preferred stock again, financing. Buildings, investing. And patents is a long-term asset, investing. Number 4, cash flows from operating activities, indirect method. Indicate whether each of the following would be an add or a deduct. This is where you need to pull out that cheat sheet. And you see in the operating activities there, we got the arrows up or down, okay? So letter A, decrease in inventory. So that's a decrease in an asset. It's the very first example there. It's an add back. Increase in AR, which is an increase in an asset. It's a subtraction. Letter C, an increase in a liability, an add back. Letter D, a loss, we said, per our cheat sheet, is an add back. Letter E, depreciation again, add back. Letter F, decrease in an asset, add back. Letter G, an increase in a liability, add back. H, decrease in an asset, add back. Letter I, amortization is just like depreciation, add back. Increase in a debt, long-term debt, or short-term debt in this case, add back. Letter K, a gain, as per our cheat sheet, is a subtraction, a deduction. Very good. Number 5, cash flows from operating activities, and it says here, the net income reported on the income statement for the current year was $93.7, depreciation $31.2, and then here's all our current assets and current liabilities. Prepare the cash flows from operating activities. So the very first thing that we should do before we do anything is, you notice there's 2 columns, end of the year, beginning of the year. A third column should be added on the very right, and it's the change that changes in those 2 accounts. So let's look at receivables, $65,000 end of the year, beginning of the year, $56,000. So our receivables changed by $9,000. So you go through, subtract the difference between all of those, and you have your amounts. We can all calculate the differences, the change. What you need to do, though, is have that cheat sheet in front of you and ask yourself, okay, AR, it went from 56 to 65. That's an increase. So an increase in a asset. That's the second example there, which is a subtraction. So going through all of those, you can then figure out, is it an add or a subtraction? This is not a trick question, but it ends up being kind of tricky. Of all of these current assets in there and current liabilities, what is the only one that we do not put in the operating section? And it would be the cash account. Because our entire cash flow statement from operating and in investing and financing, the summation of all of that will be the difference in the beginning of the year, end of the year cash account. Because the cash flow statement is showing how did our cash account change from the beginning of the year to the end of the year. So we cannot also then put it in the operating section. So looking at the solution here, operating section, we always start off with net income plus depreciation. It's given to us. Typically, then we'd say plus depreciation plus amortization. Well, there's no amortization, so we can skip it. Plus a loss minus a gain. Well, there's none of that, so we don't have to worry about it. And then we just put in all of our changes. So there was an increase in AR. There was a decrease in inventory, a decrease in prepaids, an increase in AP, and a decrease in wages payable. The summation of all of this is the net cash flow from operating activities. So start off with net income, add depreciation, amortization, plus the loss, minus a gain, and then we look at all the changes in our current assets and our current liabilities, with the exception of cash. We will stop there and take this slowly so you can look at those before we do a few more.